Donald Trump warned John Deere executives that he would drastically reshape their financial situation if they moved manufacturing operations overseas. For over a century, John Deere has stood as an emblem of American agriculture, synonymous with quality, innovation, and resilience. However, in recent years, the company has faced growing concerns about its future. Many are questioning whether this could mark the beginning of the end for one of America's most iconic brands. While the company faces multiple challenges, many critics argue that policies introduced during Trump's presidency, particularly tariffs, have been a significant factor in John Deere's mounting struggles. In this comprehensive analysis, we will explore the impact of these tariffs on John Deere, its customers, and the agricultural industry as a whole, and whether they could push the company closer to bankruptcy. Donald Trump made his position clear when John Deere announced plans to move some manufacturing operations out of the United States. Trump threatened a 200% tariff on any John Deere products manufactured overseas and sold back into the United States. His goal with tariffs was to protect American industries by making foreign goods more expensive and encouraging consumers to buy domestically produced products. On paper, this policy appeared to align with John Deere's interests. As a company deeply rooted in the heartland of America, John Deere seemed poised to benefit from these policies that prioritized domestic manufacturing and sought to strengthen American jobs. Initially, these tariffs appeared to create an opportunity for John Deere. By increasing the cost of foreign-made machinery, the price gap between John Deere's products and those of its overseas competitors narrowed. This theoretically gave John Deere a competitive edge in the U.S. market. Farmers, the company's primary customer base, were expected to see John Deere as a more attractive option compared to foreign alternatives. Many believed this could create a golden opportunity for John Deere to dominate the agricultural machinery market and boost its revenues during a time of rising global demand for farming equipment. However, the reality of the situation turned out to be far more complicated than anticipated. While the tariffs were designed to provide an advantage to companies like John Deere, they also introduced a range of unintended consequences. Farmers, already cautious about making large investments in expensive equipment, became even more hesitant in the face of economic uncertainty. For many farmers, purchasing a new tractor, combine, or other machinery from John Deere represents a significant financial commitment. They need confidence in the stability of their income and the broader agricultural market to make such decisions. Unfortunately, the tariffs disrupted this confidence, creating a volatile economic environment that made farmers reluctant to invest in new equipment. One of the most immediate and significant effects of the tariffs was the rising cost of raw materials. John Deere relies heavily on global supply chains to source components for its machinery, including essential materials like steel and aluminum. When the United States imposed tariffs on these imports, the cost of production for John Deere increased substantially. To offset these rising costs, John Deere was forced to raise the prices of its equipment. While this was necessary to maintain profitability, it created a ripple effect that hurt both the company and its customers. Farmers, already operating on razor-thin profit margins, found it increasingly difficult to afford John Deere's higher-priced equipment. This led to a noticeable decline in sales, further exacerbating the challenges facing the company. The situation was further complicated by international retaliation against Trump's tariffs. Key trading partners, including China, responded with their own tariffs targeting American goods. These retaliatory measures had a particularly severe impact on the U.S. agricultural sector, which relies heavily on exports to global markets. Crops like soybeans and corn, staples of American farming, faced reduced demand in international markets as countries like China imposed higher tariffs on these products. As a result, many American farmers experienced a significant drop in income. This further diminished their ability to invest in new machinery, directly impacting John Deere's bottom line. The combination of rising production costs and declining demand from farmers created a perfect storm for John Deere. The company found itself squeezed on both sides, with increased expenses and reduced revenue. In an effort to address these challenges, John Deere announced plans to shift some of its manufacturing operations to Mexico. This decision, while financially motivated, sparked backlash from both the public and political leaders. Trump's reaction was swift and pointed, threatening the company with a 200% tariff on any products manufactured in Mexico and sold in the United States. This controversy highlighted the broader difficulties John Deere faced in navigating both domestic and international economic pressures. While the financial challenges were significant, the tariffs also had long-term implications for John Deere's ability to innovate. Innovation has historically been a cornerstone of John Deere's success, enabling the company to lead the agricultural machinery industry with cutting-edge advancements. From autonomous tractors to precision farming tools, John Deere has consistently set the standard for technological innovation in agriculture. However, the financial strain caused by the tariffs limited John Deere's ability to invest in research and development. Without adequate funding for innovation, John Deere risked falling behind its competitors. The slowdown in innovation at John Deere has far-reaching consequences. Farmers rely on advanced technology to improve efficiency, manage resources, and address challenges such as sustainability. If John Deere cannot provide farmers with the tools they need to stay competitive, the company risks losing market share to competitors who can. This not only threatens John Deere's position as a leader in the industry, but also jeopardizes its long-term viability. Adding to John Deere's challenges is the growing momentum behind the right to repair movement. Farmers have become increasingly frustrated with John Deere's restrictive repair policies, which require them to rely on authorized dealers for repairs. These policies often make it more expensive and time-consuming for farmers to maintain their equipment. The right to repair movement advocates for farmers' ability to repair their own machinery without relying on John Deere's proprietary tools and software. As the movement gains traction, it has put additional pressure on John Deere to change its business practices. John Deere's resistance to the right to repair movement has led to legal battles and further strained its relationship with its core customer base. Many farmers, already disillusioned by rising equipment costs, are now questioning their loyalty to the brand. Competitors that offer more repair-friendly options are beginning to attract customers who are frustrated with John Deere's policies. This erosion of trust poses a significant threat to John Deere's future. The challenges facing John Deere extend beyond the company itself. If John Deere cannot overcome these obstacles, it could have far-reaching consequences for the agricultural sector. Farmers depend on John Deere's machinery to maintain productivity and profitability. A decline in John Deere's operations could lead to a reduction in the availability of reliable equipment, leaving farmers with fewer options and higher costs. This, in turn, could drive up food prices and create instability in the agricultural supply chain. The ripple effects of John Deere's struggles are a stark reminder of the interconnected nature of the global economy. Policies such as tariffs, while intended to protect domestic industries, can have unintended consequences that ripple through entire sectors. For John Deere, the combination of rising production costs, declining farmer incomes, and strained customer relationships has created a dire situation. While the company has weathered challenges in the past, the current circumstances present a unique set of difficulties that threaten its future. John Deere's ability to recover will depend on its leadership's willingness to adapt, innovate, and rebuild trust with its customer base. This will require a comprehensive strategy that addresses not only the immediate financial challenges, but also the broader issues affecting the agricultural industry. Whether John Deere can rise above these challenges, or whether this marks the beginning of the end for the company, remains to be seen. One of the critical lessons from John Deere's current predicament is the importance of foresight and adaptability in business. When the tariffs were first introduced, they were intended to protect companies like John Deere. However, the full consequences of these policies were not entirely understood at the time. In hindsight, it is clear that John Deere could have taken a more proactive approach to mitigate the risks associated with the tariffs. This might have included diversifying its supply chain, exploring alternative markets, or investing in cost reduction strategies. As John Deere faces increasing financial pressure, it is worth considering what the company can do to turn things around. One potential solution is to embrace the right to repair movement and address the concerns of farmers. By making its equipment more accessible for repairs, John Deere could rebuild trust with its customers and strengthen its position in the market. Another critical step is to invest in innovation. Despite the financial challenges, John Deere cannot afford to fall behind in technological advancements. The company must find a way to fund research and development to remain competitive. John Deere's current situation also underscores the need for collaboration between industry and government. While the tariffs were intended to protect American businesses, their implementation created unintended consequences that hurt both John Deere and its customers. Moving forward, policymakers and industry leaders must work together to develop solutions that support domestic industries without creating unnecessary economic burdens. John Deere has a long history of resilience and innovation. While the challenges it currently faces are significant, the company has the potential to recover and thrive once again. However, this will require bold leadership, strategic decision-making, and a willingness to adapt to the evolving needs of the agricultural industry. The story of John Deere serves as a cautionary tale about the complexities of global trade and the importance of balancing short-term gains with long-term sustainability. Whether John Deere can overcome these challenges and secure its future remains to be seen. But one thing is certain: the decisions made in the coming years will shape not only the fate of John Deere, but also the broader agricultural sector it serves.